AI stocks are in a bubble. That is the warning from the International Monetary Fund and the Bank of England. Even Sam Altman of OpenAI, the biggest cheerleader for the AI revolution, seems to agree. In my 18 years of investment experience, both on Wall Street and here in Europe, I've never seen anything quite like this. Today, just 10 big US tech companies make up 40% of the S&P 500 by size. Nvidia stock has grown an astonishing 68% per year for the past 5 years. If the AI bubble pops, investors could see massive losses in their portfolios. So in this video, I will share 5 methods to protect against this. But first, a reality check. It is extremely difficult to know in real time if you are in the middle of a bubble. Today's stock market is very different from 25 years ago during the dot-com bubble. Back then, investors bid up the stocks of new tech companies like Pets.com, which could barely deliver a product, let alone make a profit. Today, companies like Apple and Microsoft and Nvidia, they have huge revenues, and they've been profitable for years. Plus, their profits have been growing fast. Also, AI performance has been improving really fast. The latest models are capable of winning gold at the International Math Olympiad, and that's not easy. So, it is possible that we are not actually in a bubble. There are valid reasons to be optimistic about the stock market, especially if you have a long-term perspective and don't worry too much about short-term ups and downs. That said, US tech stock valuations are incredibly high. The trailing PE ratio for Nvidia is 54. For Microsoft, it's 38. For Tesla, it's a whopping 259. Roughly speaking, that means it takes $259 to buy $1 of Tesla profits. Then you have all the news about this circular AI economy where Nvidia invests in AI companies like OpenAI and xAI, and then those companies buy Nvidia chips, and this inflates everybody's numbers. Plus, if you use AI tools day to day like I do, you know that right now they can be super helpful in many ways, but for the big, really important jobs, they are almost never good enough. According to a recent report from MIT, 95% of generative AI pilots at companies are failing. And to me, that's not surprising. What is more, from a historical perspective, having an AI bubble wouldn't be unusual. Professor Carlota Perez pointed out 20 years ago that when a new technological revolution happens, there's usually a huge build-out of infrastructure, which is often accompanied by a financial bubble, because there are many overly optimistic investors. Then the bubble pops, and those investors suffer big losses. Now, over the following years, all that new infrastructure, it enables incredible economic growth, but that doesn't save you from the original crash. This happened with the Industrial Revolution, it happened with computers and the internet, and it might be happening with AI right now. Now, in my personal view, investors shouldn't really try to predict if and when the AI bubble will burst. Making these kinds of stock market predictions is extremely difficult. But if you are concerned about this, you can position your portfolio to guard against these risks. Method 1 is to check your basics. To start, make sure that you have a safety cushion, some money that's sitting in the bank, enough to cover living expenses for a few months if there is a major crash and you need money quickly. Then, check that you're not taking too much risk in your portfolio for your personal comfort level. When the market is going up for year after year, many people imagine they can handle any amount of risk. They go 100% into stocks. But people's ability to stay calm when the market falls is often much lower than they estimate. Imagine your portfolio falling by 50%. Can you stay calm and not panic? If this seems impossible, then you might want to reduce your risk today while stocks are still high. Finally, make sure that your portfolio fits your age and goals. If you're 20 and have 70 years ahead of you, being 100% in stocks can make sense. But if you're 60 and close to retirement, that is likely to be too much risk, and you could be too exposed if a bubble pops. Taking care of these basics is the absolute minimum that every investor should do. But if you want a better level of protection from a bubble, then let's move on to method 2. Now, to understand this method, Imagine that you walk to work every day and you can choose between two streets. One is a little shorter and it's beautiful to look at, but it's got kind of a bad reputation. You're worried about pickpockets or bandits. Now, the other route is longer and it's not as beautiful, but it's really safe. If you're worried about your physical safety, which street would you take? It's obvious, right? But with investing, many people think there's only one street: buying the S&P 500, investing in big US companies where 40% of your money is going to go into AI-heavy tech stocks. If you're not comfortable with that risk, well, nobody's forcing you to go down that road. According to financial theory, a good portfolio simply needs to be low cost and diversified. You should cover many different stocks, many industries, and ideally many countries. But there are a lot of ways you can achieve that without investing in America at all. You can buy ex-US ETFs, which focus on stocks outside of America. You can buy European or emerging market stock ETFs. Now, to be sure, if the AI bubble crashes, other markets will be affected as well. But if you follow method 2 and invest outside the US, the impact should be much smaller. All right, but maybe you're thinking, what if AI is not a bubble? What if the AI revolution really does succeed and those big tech companies become even more profitable than ever before? Maybe you don't want to miss out on that. Well, if so, then you can use method number 3, which is diversify. Don't put 100% of your money into America, but don't exclude it either. Instead of just buying the S&P 500, you can buy an MSCI World ETF like this one, which covers developed market stocks, or a FTSE All World ETF like this one, which covers both developed and emerging markets. Now, of course, you should keep in mind that even with an All World ETF, around 60% of your money still ends up in America, so an AI crash would still be painful. But on the flip side, if the AI revolution succeeds, you would really benefit. Now, this has been my personal strategy. I've been a globally diversified investor for years, and even though I am quite concerned about the current market situation, I'm not changing my approach because I know that jumping from one strategy to another, trying to time the market, is extremely difficult. Okay, so this is method number 3, diversify globally. With method number 4, you don't avoid US tech stocks geographically, you avoid them by what is called factor investing. For example, if you buy a small cap ETF, you will invest your money in hundreds or thousands of small companies. None of these are going to be the big tech stocks which are getting overhyped because of AI. Or you can buy a value ETF. This gives you exposure to companies whose stock prices are low compared to their financial fundamentals. That is another way to avoid overly expensive stocks. And then many smart investors like combining these two factors. They invest in so-called small cap value ETFs, which target small and reasonably priced companies. Small cap value did really well during the big financial crisis. Between 2000 and 2010, the SPDR S&P 500 ETF returned just 0.35% per year, while the DFA US Small Cap Value ETF returned 10.95% per year on average. So if you chose this approach, you would have done great in a really difficult period. But you do have to keep in mind that past results don't guarantee that the future will be the same, and factor funds aren't guaranteed to outperform long term. For example, over a longer time period, between 2000 and 2025, the S&P 500 ETF earned 14% per year on average, compared to just 10% per year for the small cap value ETF. But this can be another interesting alternative. So that's method 4, factor investing. And finally, we come to method 5. What if you could keep a portfolio with plenty of US tech stocks and still get some upside if AI succeeds, but also protect yourself if the market crashes? What if you could essentially buy insurance against the market crash? Now, the hard way to do this would be with options. For example, you could buy put options on the S&P 500. These would protect you from losses on your portfolio below a certain point, like maybe 10% down or 20% down. Now, of course, buying these kinds of put options, buying this insurance is quite expensive. It would cost you several percent of your investment amount per year. Also, doing this well requires a lot of skill. It is quite risky if you make a mistake. Plus, most brokers that European investors use won't even give you access to options trading. Because my channel isn't really aimed at traders, I won't explore this in detail. The easier way to get this kind of exposure would be to buy a pre-packaged investment product with downside protection built in, like the so-called structured notes that a lot of European banks will offer to sell you. Structured notes are pretty complex investments, but they typically protect your portfolio from various levels of losses, and then in return you either have higher fees or you accept a limit on how much profit you can earn, or there's a combination of both. These kinds of notes have historically tended to be quite expensive, but these days some of these products are also available in ETF form with relatively lower costs. For example, just recently in October 2025, iShares has launched the iShares US Large Cap Deep Buffer UCITS ETF and the iShares Large Cap Max Buffer SEP UCITS ETF. To be clear, this is not an investment recommendation. These are complex products and you should study carefully if they're appropriate for you. But just to give you an idea, the Max Buffer ETF aims to limit your possible losses between October 1st, 2025 and September 2026 to 0.52%, while capping your potential profits at approximately 7%. Except you have to keep in mind that dividends are not included, so for you to make money, stock prices have to go up. Structured products like this do have some significant drawbacks. For one thing, they can be complex and a bit difficult to understand. There can be hidden costs that you end up paying, which are associated with the underlying complex financial machinery that is used to protect your money. And these costs may never appear in any fund cost document. And for another thing, there is simply no free lunch in investing. If you add this kind of complexity to your portfolio, well, yes, it can make your portfolio less volatile, it can be easier on your nerves, but your expected long-term returns do become lower than if you simply invest in the whole market without worrying about this stuff. For those reasons, I personally don't use these products. But I do think they can be quite attractive to risk-averse investors who really don't want significant losses in their account while still getting some of the benefits of stock investing. Just do pay close attention to the costs and investigate how each specific product works, because there can be big differences. Okay, but if you live in Europe and want to succeed with any of these methods, you need to understand how investing works here. Too many people just read some American blog and go buy ETFs without understanding what they're doing, and they make a lot of mistakes because investing from Europe is different than investing from America. To avoid this problem, watch this video next, where I explain the best way to start ETF investing here in Europe.